Hello, money and banking students. This week our focus is Chapter 15, and in this chapter we'll learn about the money supply process and money multipliers. We'll learn how central banks influence the money supply, and we'll also learn how banks, borrowers, and depositors influence the money supply. Last week we studied central banks, and in the U.S. the central bank is the Federal Reserve. When we look at the balance sheet of a central bank, the asset side looks very similar to that of what any bank would look like. The assets consist of government securities and then loans, but these loans that the central bank makes are actually made to commercial banks. So this side of the balance sheet looks a lot like any banks would. The liability side is different. On the liability side, currency that is outstanding, Federal Reserve notes, is actually a liability of the central bank. They have to make good when those notes are redeemed. And then reserves that the commercial banks hold at the Fed are also a liability because the central bank basically owes those reserves back to the commercial bank upon demand. A key point of this chapter is money supply is determined by the interaction of four groups: commercial banks and other depositories like credit unions, depositors, borrowers, and the central bank. This is the monetary base equation. Monetary base equals currency in circulation plus reserves. Monetary base is also known as high-powered money. We can take the basic equation and expand it. So currency equals all the notes and coins in circulation. Reserves, that would be vault cash that a bank has in its vault plus its reserves on deposit at the Fed. And then reserves, we've talked about this before: required reserves, federal requirement, and excess reserves. So we could say that the monetary base equals currency plus vault cash plus reserves on deposit at the Fed. Or we could say monetary base equals currency plus required reserves plus excess reserves. All of the four groups can influence money supply. The central bank can influence the money supply by determining how much currency is issued and reserve requirements. Banks, by how much money they have in circulation by lending money and how much they retain in vault cash and reserves. And then depositors and borrowers, the same thing: how much money that they have in circulation and then how much they have in deposit at various depository institutions. As we look at the central bank's balance sheet, obviously the assets earn interest. The government securities that they own will pay interest, and they can sell them at a gain or loss. And the loans that they make to commercial banks accrue interest. The main difference is that for the central bank, liabilities are costless. When a commercial bank needs some of their reserves back or make reserves with a commercial bank, that is an accounting entry. And when the central bank puts more currency in the situation, that is just a matter of running the printing presses. So basically, wouldn't you like a business where all of your assets were earning interest but your liabilities were costing you nothing? That's what the central bank has. In section 2 of the text, we look at open market operations, and basically open market operations are another way that the central bank can affect the monetary base. Central banks conduct open market operations by buying or selling securities. So here's an example of how the central bank increases the monetary base. Let's say the central bank buys a security from a commercial bank. On the central bank's balance sheet, its securities increase because it bought the security from the bank. Its liabilities, the reserves that it owes the commercial bank, also increase because it's going to put money in that commercial bank's account. On the commercial bank side, its securities decrease and its reserves with the Fed increase. Now let's say a central bank buys a security from a non-bank. Maybe it's from a mutual fund or an insurance company. In this case, central bank's securities will increase, its reserves will increase. For the non-bank, it sold its securities, so those decrease. Its deposit to the commercial bank increased. For the bank that it deposited to, deposits increased, but its reserves also increased. This is what the transaction looks like if the non-bank just retains the cash and does not deposit it into a depository bank. So the central bank increases the monetary base when it buys a security. Think of it this way. You own a security, central bank gives you cash, so cash is injected into your economy, and you, in exchange, give up that security to the central bank. The monetary base increases by the amount of the purchase because either currency or reserves increase by the amount of the purchase. Let's say the central bank wants to decrease the monetary base. In that case, it would sell securities and take cash out of circulation. So for the central bank, it decreased its securities. It also decreased the reserves that it owes the commercial bank. For the commercial bank, it gained securities, but its reserves decreased. So when the central bank sells an asset like a security, the monetary base shrinks because currency and or reserves decrease along with the central bank securities holdings, and banks or the non-bank public own more securities but less cash or reserves. Another way central banks can increase the monetary base is by loaning to commercial banks. So in this case, if a central bank makes a loan to a commercial bank, the central bank's loans receivable increase, its reserves that it owes the commercial bank increase. The commercial bank, it now has a loan payable, so its liabilities increased, but it also gained a reserve credit with the central bank, so that it was an increase. Vice versa, if the central bank wants to decrease the monetary base, banks will repay loans to the central bank. So in this case, for the central bank, its loans receivable decrease, its reserves that it owes the commercial bank decrease. Commercial bank, its loans payable decrease, but because it used its reserves to pay it off, the reserves also decreased. So to summarize, central banks influence the money supply via the monetary base by either buying or selling securities through open market operations or lending to banks. Commercial banks influence the money supply via the monetary base by buying and selling securities with the central bank or borrowing from the central bank. It should be noted that commercial banks, their influence when they buy or sell securities with the central bank is by affecting currency or reserves, not the monetary base itself. Okay, that's a brief overview of the first part of Chapter 15. I will post an additional video to wrap up the remainder of Chapter 15.